You bought the house. You sat at a sterile conference table and signed a stack of papers a foot thick, your hand cramping as you initialed page after identical page. You wired a sum of money that made your hands shake, watching a lifetime of savings vanish from one screen and reappear as a line item on another. And you got the keys. Every month since, you make the payment. On time, without fail. You see the loan balance on your bank portal slowly, so slowly, tick down. And you believe, with the full force of a lifetime of cultural conditioning, that you are building equity, turning your labor into a solid, tangible asset, that you are making that house yours.
But what if for the first 7, even 10 years, you are functionally a renter with maintenance duties? What if the system is engineered to give you the feeling of ownership while transferring the vast majority of your payments directly to the lender's profit column? What if the very tool you were told would secure your freedom, the 30-year mortgage, is, by its pure mathematical design, a golden cage? It keeps you tethered, compliant, and productive for decades, not through force, but through comfort. This isn't a conspiracy, it's just an incentive structure, expressed in math, and I'm going to prove it. The story is one you know in your bones because it's the story we were all told. It's the plot of the American movie. You played the game exactly as you were told. You listened to your parents, your friends, the news. You internalized the message that renting was throwing money away. You worked, you saved, you sacrificed.
You scrolled through listings for months, maybe years, your phone glowing in the dark, imagining your life inside those digital boxes. You stretched your budget for the right school district, for the shorter commute, for the yard you pictured your kids playing in. You survived the emotional roller coaster of making an offer, the counteroffer, the inspection, the appraisal. You won the bidding war. You felt that profound, chest-swelling sense of arrival when you closed. This isn't just drywall and copper pipe. It's a landmark in your life, a statement to the world and to yourself that you have made it. And above all, you were told, it's an investment. The bedrock of middle-class wealth, the single greatest financial decision you will ever make. The formula seems so simple, so pure. Pay down the loan, watch the property value climb, and one day you'll be free. Your labor will be transmuted into a physical asset, a fortress of security for your family.
You feel the weight of it, of course. The lawn that needs mowing, the furnace that sounds a little funny in the dead of winter, the property tax bill that arrives like a punishment for your success, always, always going up. But you accept these burdens as the cost of admission. It's what owners do. It's responsibility. You might see a neighbor's house sell for $50,000 more than you paid, and you feel that quiet rush of validation. See? It's working. The asset is growing. You're a homeowner. The system is functioning as advertised. And yet, there's a quiet dissonance, isn't there? A feeling, late at night when you're looking at the budget spreadsheet, that the numbers don't add up to the freedom you expected. There's a subtle friction to your financial life. Despite making payments that dwarf what you ever paid in rent, your cash flow feels just as precarious, if not more so. The net worth on paper, that number you see on Zillow or Redfin, doesn't translate to cash in the bank. It doesn't pay for the new tires on the car or the braces for your kid. The house feels less like a launch pad and more like a beautifully decorated anchor. You're running faster than ever, your income is higher than ever, but you feel like you're just staying in the same place. This feeling has a name. It's the slow, creeping realization that the rules you were given don't produce the results you were promised. Let's put a number to that nagging feeling. Let's take a crowbar to that hairline crack in the foundation and see what's really underneath. Imagine you bought a home for $400,000. You did everything right. You put down 20%, or $80,000, to avoid the dreaded private mortgage insurance. You financed the remaining $320,000 with a 30-year fixed mortgage at what seems like a reasonable 7% interest rate. Your monthly payment for just the principal and interest is about $2,129. Now, fast forward 5 years. You've made 60 on-time payments, never missed one. You've been the perfect borrower. 60 times that $2,129 has left your bank account. That's a total of $127,740, a massive sum of money by any standard.
You are 1/6 of the way through the loan's 30-year term. A logical person, a person who thinks in straight lines, might assume you've paid off a significant chunk of the principal. You know there's interest, you're not naive, but surely you've knocked off $50,000? $60,000? You open your loan statement, maybe with a little trepidation, but also expecting that hit of validation, the proof that your sacrifice is paying off. And your stomach drops. After 5 years and $127,740 in payments, your principal balance of $320,000 has only been reduced by about $22,000. Let that sink in. You sent them the price of a new luxury car. They credited you with the price of a used Honda Civic. Over $105,000 of your money, more than 82% of everything you paid for 5 full years, vanished. It didn't build your equity.
It didn't pay down your debt. It went to one thing: interest. It was the lender's profit. It was the fee you paid to rent their money for 1,825 days. The feeling of building something is suddenly replaced by the cold, brutal reality of the math. You've been spinning your wheels in the mud and the bank has been charging you for the gasoline. This is the first crack, and it goes all the way to the foundation. This isn't a mistake. It is the system. It's a mechanism called amortization, specifically front-loaded interest amortization. The concept is ancient, but its modern application in the 30-year mortgage is a quiet masterpiece of financial engineering. It was born out of the era of the Great Depression, designed by the federal government to make housing more accessible and stimulate the economy. But over time, the incentive structure it created was perfected by lenders. It wasn't designed for your rapid wealth building. It was designed to solve a critical problem for the lender. How do we lend vast sums of money for incredibly long periods, minimize our risk to near zero, and maximize our profit, especially in the early years when a borrower is most likely to move or refinance? The answer is an elegant, almost invisible piece of mathematical architecture. Structure the loan so you pay them their profit first. Here's how the machine works. Every month, your payment is sliced in two. One part goes to the principal, the actual money you borrowed. The other part goes to interest, the lender's fee. But the slice isn't even. In fact, for the first decade, it's not even close. The lender calculates the interest owed for that month based on your entire remaining balance. At the beginning of the loan, your balance is at its absolute highest. Therefore, the interest portion of your payment is also at its highest. An overwhelming majority of your check is consumed by the interest charge. Only the leftover crumbs, the pocket change, are applied to your principal. Next month, your principal is now microscopically smaller. So, the interest charge is microscopically smaller, which means a microscopically larger crumb can be applied to the principal. This process repeats, month after month, year after grinding year, in a slow, relentless transfer of your wealth to their balance sheet. It is a perfect, self-regulating engine for extracting profit. It's brilliant because it plays on a fundamental weakness in human psychology. We focus on the affordable monthly payment, not the devastating long-term cost. We can budget for $2,000 a month. We cannot properly comprehend $100,000 in interest over 5 years. The system is designed around that cognitive blind spot. Let's go back to that hypothetical $320,000 loan at 7% for 30 years. Your monthly principal and interest payment is a fixed $2,129. In month 1, your loan balance is $320,000. The interest due for that single month is calculated $320,000 multiplied by the annual interest rate of 7%, then divided by 12 months, which equals $1,867. So of your $2,129 payment, a staggering $1,867 is pure interest. Only $222 actually goes to paying down your debt. You just made a payment of over $2,000 to reduce your loan by the cost of a nice dinner out. By the end of year 1, you've paid them $25,548. Your principal has only decreased by about $3,200. The other $22,348 was their profit. By the end of year 5, as we saw, you've paid $127,740. Only $22,000 of that went to your equity. The other $105,740 was their profit.
By the end of year 10, you've paid $250,000, $255,480. Your principal, the actual loan, has only been reduced by about $53,000. You have paid over $200,000 for the privilege of borrowing $320,000 for a decade. You're a third of the way through the loan term, but you've only paid off about 16% of the loan.
The math feels wrong. It feels like a trick, but it's just the cold, unblinking logic of the amortization schedule. Here is the number that should stop you in your tracks. On this standard, common loan, the halfway point, the moment your monthly payment finally sends more money to your principal than to their interest, doesn't arrive until month 2022. That is 18 and a half years into a 30-year loan. For nearly 2 decades, the primary beneficiary of your monthly housing payment is the lender. For nearly 2 decades, you are primarily working to enrich a financial institution, not to own your home. Who benefits from this architecture? The lending institution. It's a brilliant business model. It ensures they recoup a massive portion of their potential profit in the first few years. The system is built around an observable truth. People move, careers change, families grow, divorces happen, life happens. The average homeowner stays in their home for around 10 to 13 years, selling or refinancing long before their 30-year term is up. By front-loading the interest, lenders guarantee that even if you leave the loan early, as most people do, they've already extracted the sweetest, most profitable part of the deal. They get their dessert first. You get the leftovers, decades later, if you stick around that long. This design is not the product of some smoke-filled room of villains plotting against the middle class. There is no mustache-twirling banker. It's worse. It's the result of a perfectly rational, amoral, profit-maximizing incentive structure that has evolved over decades. From the lender's perspective, this is not predatory. It is prudent risk management. It is, by their metrics, good business. And its cold, impersonal logic is far more insidious than any conspiracy, because it requires no malice to function. It just requires your participation.
You think you're a homeowner building a life. The bank's balance sheet lists you as a long-term, high-yield debtor. Both are true, but only one of those truths defines your financial reality for the first decade. Let's make this human. Meet Sarah. She's 42, a senior project manager at a tech company, married to a high school teacher. Their household brings in a solid $180,000 a year. 7 years ago, they bought their forever home for $600,000 in a competitive suburb. They did everything by the book, drained their savings, cashed out some old stock, and accepted gift money from their parents to pull together a 20% down payment of $120,000. They financed the remaining $480,000 at a 6.5% interest rate for 30 years. Their principal and interest payment is $3,034 a month. They felt like they had summited a mountain. They were owners. For 7 years, that $3,034 payment has been the unmovable center of their financial universe.
Wait to make it happen. They made choices, the quiet sacrifices that define modern middle-class life. The second car is a 12-year-old sedan with a rattling sound they've learned to ignore. Vacations have been trips to a state park, not to Europe. Her husband hasn't bought a new suit in 5 years. A few years ago, after months of agonizing, whispered discussions late at night, they quietly decided against the IVF treatment they'd considered for a third child. The cost was just too high, the outcome too uncertain. They told themselves their 2 kids were a profound blessing, and that securing this home, this future, was the most responsible choice. They sacrificed a possible future for a stable present. 7 years passed, 84 payments, a total of $254,856 paid to their mortgage lender. Sarah knows the house has appreciated. The Zillow estimates, now glowing at $750,000, is a source of quiet pride, a number she sometimes pulls up on her phone for a little hit of dopamine. But recently, she logged into her loan portal to look at the actual numbers for a potential home equity line of credit. What she felt next was not pride. It was a cold, hollowing sensation she could only describe as trapped competence. The original loan was $480,000.
After 7 years of relentless on-time payments, her principal balance was still approximately $437,000. They had reduced their debt by only $43,000. She did the math on her phone calculator, her thumb hovering over the screen in disbelief. Out of the $250,000 they had paid, over $211,000 of it was pure interest. Gone. It had purchased them nothing but time. The sacrifice for the third child, the rattling car, the foregone travel, all of that effort, all of that life, had been transmuted into pure profit for a financial institution. She was a project manager. She managed multi-million-dollar budgets at work, tracking every dollar, optimizing every outcome. She was competent. She was responsible. She had done everything right, and the system had rewarded her competence by using it as fuel for its own engine, leaving her with a pittance of equity to show for nearly a decade of her family's life and labor. She wasn't building wealth, she was servicing debt. And the wealth she saw on Zillow? That was just market luck, a rising tide. It had nothing to do with her discipline. It felt like winning a lottery ticket after spending a decade in a labor camp. This mechanism doesn't just trap one family. It shapes the entire economy. When millions of households are locked in this decade-long equity dead zone, it creates profound systemic consequences that keep the middle class on a treadmill. First, it creates a perpetual mortgage cycle. Because equity builds so slowly in the early years, the primary way for many to access the supposed wealth in their home is to wait for market appreciation, and then refinance or sell. But every time you refinance, even for a lower rate, you reset the amortization clock. You start a new 30-year loan right back at the beginning in the high-interest phase. Lenders encourage this with a constant stream of marketing. Use your home's equity, they say. It's a feature, not a bug. This churn keeps homeowners on the hook, perpetually in the most profitable phase of the loan for the lender. You're not escaping the trap, you're just paying a fee to have it reset. Second, it suppresses small business formation and risk-taking. The classic American dream is to borrow against home equity to start a business. That's how countless small companies were born in past generations. But if you have negligible real, paid-for equity for the first 7 to 10 years, that option is off the table. The system subtly encourages stability and discourages entrepreneurship. It needs you to keep your steady job to make that steady payment. Your home, the supposed symbol of freedom, becomes a primary instrument of your economic compliance, chaining you to the W-2 income you need to service the debt. Third, it makes the middle class profoundly vulnerable to housing market corrections. Because your actual paid-for equity is so low, your entire financial position as a homeowner is propped up by market sentiment. If the market goes up 20% in 5 years, you feel like a genius, but that wealth isn't from your diligent payments. It's from the market. It's unearned, and it can vanish just as quickly. If the market stagnates or drops 10%, your paper gains are wiped out, and you are left exposed with a massive loan and very little real ownership. You can easily find yourself underwater, owing more than the house is worth. You are a leveraged speculator, whether you realize it or not. And the bank has structured the deal so they have the least amount of risk, and you have the most. So it's time we reframe what homeownership means in the first 10 years of a 30-year mortgage. It's time to correct the language, because the language is part of the trap. You are not an owner. You are a steward with a long-term purchase option. When you get the keys, you are granted stewardship of the property. You have the right to live there, the privilege of painting the walls, and the full responsibility for fixing the roof when it leaks. But the true financial owner of the asset is the lender. They hold the title. They have the primary claim. You have essentially purchased a 30-year subscription to a single-family home. For the first decade, your payments are almost entirely subscription fees. After that, your payments slowly, painfully, begin to purchase tiny fractions of the asset itself. If you complete all 360 subscription payments, you get to buy the asset outright for the final payment. Calling yourself a homeowner in year 3 is like calling yourself a marathon finisher at mile 4. You're on the course, but the destination is a long, long way away. The system is not designed to make you wealthy. It is designed to make lenders profitable. It provides the essential function of supplying capital for housing, but it does so on terms that are overwhelmingly favorable to its architects. The slow grind of amortization is the invisible engine that powers the entire residential real estate industry. It's a beautifully efficient system for them. For you, it means the promise of building equity with every payment is a carefully crafted narrative, a story you are told to keep you making the payments, to keep you in the house, to keep you in the system. The tragedy isn't the interest you paid, it's the decade of your highest earning years you spent building their balance sheet instead of your own. You are buying your home, yes,
but you are buying it from the bank, after they have extracted their tribute, year after grinding year. They didn't build the system to trap you. They built it to keep you comfortable enough to stay. If you've made every payment on time for years and still felt like you were falling behind, what did you tell yourself the reason was?
This is one mechanism. There are others that operate the same way. Different names, different paperwork, same architecture. That's what we look at next.